Hello guys and welcome back to the channel. So in this video, in this live stream, this is going to be the first one of hopefully many episodes that I'm going to do of a thing called Wheeling with Vince. This is because like the past 1 year, I've been dabbling with options, and I kind of think it, I kind of like what I see. I've done certain trades, and I really want to learn more about it. And I also want to take you guys on this journey with me, because I think that we can learn a lot from each other. And this is why I decided to do this live, because to be honest, I'm very curious where your guys are with option trading. Where is your knowledge, and what do you feel you want to get more information on? And I really want to get live input on the things that I'm saying. So let's do some housekeeping, which I think that I'm going to say in every episode. So number one is options are very, very risky. None of the things that I say here is financial advice. It's hopefully I just spark a spark, and you go and do your due diligence and continue there. Number two, which I believe to be correct, that if you are a good stock picker and you just pick good long-term stocks like Rocket Lab, like Palantir, and you just keep your income over your expenses and you invest every month into the stock market, you are going to do better than option traders. I truly believe that, and I have proof of that. And I mean, just look at the people who only bought Palantir and Rocket Lab and just held it. They didn't do anything. And look at the people who did cover calls on their shares, like me. And I did really good last year. I did 80-something% last year, so nothing to cry about on the whole portfolio. But it could have been 380% if I don't do my cover calls. So if options are not good for you, why am I doing it? It's because they can do something that holding stocks cannot do, and that is cash flow. So I truly believe that if you, for any reason, are in need of cash flow, like you're going to retire soon, or for whatever reason, if you need cash flow, then holding Rocket Lab for 15 years is not going to help you out. And then the option strategy is something that I think is something good for you to look at. Now we're getting some people checking in here. Mark Kiwi, hi Vince, hello from Czech Republic. That's awesome. I'm just starting options as well. AI Money, Rick, looking forward to this show. Awesome. Yeah. So the best of it doesn't always work. I had actually I had quite some option trades that won. My problem is that two trades, which was my cover calls on Palantir and Rocket Lab, it's not even that I lost, because at the time when I wrote I sold the Rocket Lab cover call option, I wrote it like 60% above my stock price. And so the stock went up 60% and then 4x'd. So I technically got 60%, but I didn't get as much as I could have gotten. Hello, Curtis. Nice to see you here. So I'm gonna try to keep the show at around 30 minutes, but if there is more questions and more things that you guys want to know, I will stay here and answer them. And this is developing. This is the first time I'm doing this, so probably this is the worst episode, and hopefully we get better from here. Now, I wanted to speak about the wheel strategy because I have found that strategy is probably the best for people to do. And this is when I don't know where your knowledge is, so I'm just going to do a short summary of this. So basically, in a nutshell, the wheel strategy is that you sell put options on a stock that you like, and you get premiums. So you use, let's say, 100,000 that is on your account, and then instead of buying the stock for 100,000, let's say you sell and let's keep it real simple because we're Rocket Lab people here. So you say at $20, I'm willing to buy Rocket Lab. So you sell a $20 put option. And basically, let's say you sell it for 1 month and you get paid, probably because Rocket Lab has insane premiums right now, 4 or 5% for that transaction. Oh my God, Mark, you became a new member. Thank you so much. So you sell put options, and on this transaction, you either win or you win, because if Rocket Lab doesn't go below $20, you keep the premium that you collected. If Rocket Lab goes below $20, then you got paid to wait for the stock you want to own to go to the price that you want to buy it at, right? So once you were assigned the stock, so if you're not assigned the stock, then you just keep selling the put options until you get assigned. And then once you're assigned the stock, then you start selling covered calls, meaning, let's say we take the example of Rocket Lab. Let's say we go down to $19. You were assigned the shares, and now you have $100,000 of Rocket Lab at $19. And now you start selling call options on it, and you say that I'm willing to sell these shares at $24. And again, it's a win-win, because if the stock price stays at 19 or below, you just keep the premium. And if it doesn't stay, like it goes to 25, then hopefully you're happy to sell your shares, and then you're back to cash again, and then you start again with selling puts. Now, this sounds simple. This is what all the YouTubers say when you watch the videos. It's super simple, and you just make money all the way. They just don't tell you that this is quite an idiotic strategy, because the reason why this is an idiotic strategy is you have to have some experience and know certain things. So one of them is you should only be doing this on stocks that you want to own for the prices that you want to own. So most people make this mistake that they're like, let's go for the premium. And you know, the Bitcoin miners, they're awesome. Let's sell put options on them. And then the stocks crash. And then they get assigned the stocks, and then they don't know what to do, because they never wanted to own these stocks. They don't have conviction. It's actually very similar to just buying the shares and holding them for the long term, because you need to do it on stocks where you know the companies, you have good conviction, and you only win on this strategy if the stock that you chose doesn't collapse. It's not needed that the stock price goes up, but you need the stock to not collapse. So I give you an example. I sold put options on Enphase at $105, and a week after I sold it, Enphase tanked to like $80, right? And I made this mistake because I don't have the highest conviction about Enphase, yet I sold the put option. And then, you know, if you listen to the YouTube videos, it should be all like super easy and, you know, unicorns flying around. It did not happen to me. I got like a cold shower that the stock is that low. And I was like, what the F do I do now? Because I got assigned the stocks at 100, I'm minus 20%. And on top of it, I don't even like the stock. And then the stock, funny enough, fell to $60. And then I was like, okay, now I'm starting to like the stock. Like, I don't know so much about Enphase, but the price has gotten so low that now I'm really starting to like the stock. So the reason number one why wheeling is idiotic is that if you don't do it on stocks that you want to own and at prices that you want to own, then you're going to be assigned stocks at stupid prices, and you will not know what you have, and you will not know what to do. Number two, why this is idiotic, is because then if you get assigned on a stock that you like for example, I did on Rocket Lab, and then you sell a call option on it, when you're bullish on the stock, it means that you limit your upside. Exactly what happened to me. So let's say you're thinking Rocket Lab or Tesla or Palantir, or name your company, is going to be the next $1 trillion company. In Tesla's case, the next $10 trillion company. And then you limit your gain at 5 or 10% to have your monthly cash flow, and the stock goes 100%. Exactly what happened to me. You're going to look like an idiot despite you are right on your stock pick. So if this is an idiotic strategy, then why do I like this strategy and why do I think that this is worth exploring? So there's two answers to this question. One of them is that you are allowed to sell options on margin, meaning that you don't actually need to have the cash in your account. And you are, maybe I'm going to talk more about this later. So that means that you can use the bank's money to use as a collateral, and you still get paid for writing the put options. And this means that you can create a much higher revenue or much higher return on your money than without leverage, and it's still quite safe. So let me give you an example, because we're a Rocket Lab gang. It's probably not the good example, but let's say you know that if Rocket Lab would crash to $10, you would sell the farm, sell your kidney, sell your kids, take loans, and you would invest everything into Rocket Lab. But you currently don't have money to make cash secured puts. Then what you could do is use the margin on your account and say that I'm willing to buy $100,000 worth of Rocket Lab shares. I'm just giving examples here at $10, and you would get paid 2-3% on your 100. So you would make $2,000 to $3,000 for that. But you never put up the money. But you would know that, again, this is very risky because there is a chance that you get assigned, and then you have to know that at that time you have to handle the money, or you have to roll the option. That's also another thing that you can do. So this lessens the idiocy of the strategy. Again, the next thing that it actually creates cash flow, and if you don't force your trades, again, this is something that I learned now from 1 year of experience, which is not a lot. That if you say, okay, it's the 1st of January, I need to sell my options because at the end of January I need the income. That's a stupid way to sell options. When you sell options is, Rocket Lab went from $30 down to $22, and the RSI is very low, and it's very not likely to go lower. Then you sell a $20 put option, not because you need the income, but because the stock is in a place that is very unlikely to go lower, and you're anyways happy to buy at $20. And if you get assigned those shares, you don't straight away sell a call option because you think, okay, Rocket Lab is going to rally to $40. So you actually just sit on your shares a little bit. This is the right way to do wheeling, or the sensible way that lessens the idiocy of the strategy. And then once Rocket Lab goes to $28, $30, and the RSI starts to be high, then you can start writing call options for $34, $35, and then you don't only win the premium on the Rocket Lab call option, you also win the difference between $20 and your strike price. So this way, the strategy is not so idiotic. But again, it takes very good investor sentiment and not forcing your trades. And in the beginning, as a beginning option investor, I had a huge issue with it. I just wanted to trade to pull in premiums. And number 3 is a very advanced strategy that I learned from TJ, the Wheel Deal, is that if you're very bullish on the stock, the first time when you write call options, you can use that money and maybe add to that money to buy leap options, like very long-term call options on your stock. And that way, if the stock runs away from you, like it happened to me, you are still protected by the leap options and you're not losing out on the money. So when you put these things into perspective, or put these things together, it's a pretty okay strategy that is definitely worth studying about. I still think the better way to invest and the less time intensive and is just keeping your income high, expenses low every month, buy the company that you have the best conviction in. And I truly believe you will do better if you have companies like Palantir and Rocket Lab than the option strategy people. Again, if you need the income, then maybe you can have 50% of your portfolio in long-term stocks and 50% of your portfolio in this option trading income producing part. And have a little notes here on what I want to speak to you about, and I'm going to get to your questions very soon. So when you watch other YouTube videos, so on this channel, when I talk about options, I want to make it so this is a no hype option channel, because I hate watching, let's say, Invest with Henry, and he's like, you're going to change your life. You trade options and you're going to make $5,000 a month from, when you begin. It doesn't work like that. It's just like any new activity that you learn. First, you're going to probably lose money. You're going to make a lot of mistakes. And it takes time to learn. And again, it has its pros and cons. So I want to keep it no hype. And I want to talk about, be very transparent with you and show the things that nobody talks about, because I haven't seen any wheeling YouTube videos about, okay, you like Rocket Lab at $20, you sell the put option, you get assigned Rocket Lab, and then you sell your call option at 24 and Rocket Lab goes to 80. Like, what do you do then? And then, okay, your share is taken, Rocket Lab is 80, and you made 10% this month, which is not bad, but you missed out on a 4x, and then you don't think the stock is worth 80. So what do you do at that time? Because you wouldn't write a put option then at 70, because what if the stock crashes down to $30 again? So there's a lot of weird scenarios that happen, and I want to take all these up. So now I want to see your questions, and then I want to show you what I have done this week with my options. Rick AI Money, you need to have conviction that the put option strike is a good value for you to take ownership, even if it goes below that. Exactly. So the purpose, I think, when you do the key thing when you do the wheeling strategy is you need to create situations where you win no matter what. Or as TJ likes to say it, if it's heads, I win. If it's tails, you lose. So again, let's say you don't do options and you say, if Rocket Lab goes below 20, I'm buying no matter what, right? Then you selling a put option, it doesn't change anything for $20, because you are doing the exact same thing you would be doing anyways, which is when Rocket Lab goes below 20, you buy. Except this time you get paid to wait, and if Rocket Lab never goes below 20, you just keep the premium. And same thing with the cover call, as I painfully learned, you write the cover call at a price that you would be willing to sell. So if you're an Uber bull on Rocket Lab and you were assigned Rocket Lab stock at $20, and you think it's a $60 stock, then you don't freaking write calls at $24 just to bring premiums, or you buy the leap call options to be protected. Let me see. When a stock is tanking or red day, you get better premiums. That's very, very true. So again, this is what I said, that you don't force your trades. The bad reason to sell options is, it's January 1st. I need to sell 1 month options because I need the pay at the end of the month. The good reason to sell a put option is the stock went from 30 to 20 and you think it's a screaming deal, and very unlikely that it will go below 18, but if it does, you would buy, and then you sell on a red day. You get very good premiums. How the assignment of in the money sold puts work? Can't the puts be rolled far lower the same way as cover calls? Exactly. Puts and calls can be rolled. Sometimes you have to pay. And in my opinion, you don't have to be so like, for example, I had an M-Phase put option at $72. The stock went below 72 pretty much the whole holding period of the option. It was quite an aggressive option. And then when it was, I think on the last day or 2 days before it expired, I just added 1 month to the option. So because I do believe M-Phase wants to go back up to 100, I just don't know when. And I even got paid like $3,000-$4,000 extra because I added that 1 month extra time to the option. If I wouldn't want to get paid, I wanted to have it safer. I could have gone from 72 to maybe $70. If I would have wanted to go lower, then I would have had to pay to roll. Yeah, exactly. More Kiwi. You see, you need to be teaching me about options. Yeah, I got called on some Rocket Lab cover calls around $8, spent it all on in the money leaps, made a killing. Yeah, very good for you. Cool. So now I want to show you guys my options portfolio and what I did this week. Maybe I should start with this and the monologue after. Anyways, it's the first episode. So I have Tesla sold puts and calls. I have sold a very deep in the money put on Tesla. And the reason why I did that is because I didn't have the money to buy the shares outright. But when Tesla was down in the 200s, I was extremely bullish on the stock. And this way, I cannot show it here, but I think I got paid like 190,000 for selling this option. And each time the stock goes up $1, because the option is so in the money, basically the value of this option goes down $1. So it's almost the exact same as owning the stock. But it's like synthetic, as I'm like synthetically long on Tesla, and it makes it so that I can sell covered calls on it. And you see, I sold a call option on the same amount for $500 for January 31st that I believe is going to expire out of the money, and this is going to make me about $5,000. Then here you can see my Rocket Lab position, and you can see I have $15 cover calls that I really, really hate. And I have put options on Rocket Lab, and it doesn't mean that I'm a bear. It's like I have to play with my excess liquidity and margin maintenance and buying power. And if you guys are interested, I can go into what these numbers mean. But the point is, I noticed that if I add a little bit of put options, like it makes the margin on my account like very, very safe. And then I basically wanted to have that. So that's why I have this put option as an insurance. On Palantir, you can see I have $24 calls. I also really hate them. I'm maybe going to roll them up to a 1 year, like January 2026, 35 options. I was looking at it, and the rolling up would cost me $7, but I would roll up $11. So I'm like unlocking $11 of value for paying $7. And that is a, let me take the rusty dusty calculator. So 7 divided by 11. So that means that it's a 63% return. That is basically, I consider it in the bag, because I very highly doubt that Palantir is going to go back down to $35. And I don't know where else I can get 65% on this money that I invest with this much certainty. So I basically consider it free money. So I'm, as long as the margin allows me, I am going to roll up this Palantir call option. The only way that I would not be able to roll up this Palantir call option is if Palantir goes to like 100, like back to $80 or $90, because then the delta of the option, both options, is going to be like 1-to-1, and it means that I would have to pay $11 to go up $11 in strike price, which means that I have to bind money for 0% return, which would not work. But when I checked it, when Palantir fell to like the low 60s, it was a very good trade. So I'm hoping that Palantir actually dips into the 50s, because then I could super nicely roll up my option. And here is the freaking infamous Enphase that I did. You can see that I basically got assigned the shares, 1,000 shares at $100,000, and I changed them into in the money put options. And again, I did this because it's the same as owning the share, except I'm not putting out money, I'm receiving money into my account. So I believe that for this transaction, I got like 60,000 paid to the account. And for each dollar up to $150 that Enphase goes up, I'm winning $1. And the only problem that that I get into is if the stock goes to $180, because I stopped making money after $150. So that's you know, the gimmies and gotchas of this deep in the money put. And I started hedging in this on this stock. So the stock price is extremely low. So I bought a 10 contract leap option for next year. And the reason why I did this is because I want to sell call options on Enphase, but the stock price has only been falling. RSI is, you know, almost down in the 30s. So I don't want to force the trade. I believe that in a week or two, we're going to get a bounce and we're going to be up in $80. And that's when I'm going to sell the call option. I don't want to be stupid about it. And then you see I have a $72 put option. This is the one that I told you guys that I rolled. And this is like underwater currently, but I'm not worried about it at all. And if the stock is not above the strike price on January 31, I am just going to roll that option. So that was the portfolio. My plan with this portfolio is I really would like to be able to sell puts and calls simultaneously on 3 positions. I don't know what those 3 positions are going to be. And currently my problem is that my margin does not allow me to sell more puts on any stocks. And I can only sell, or like I have the existing puts on Enphase, and obviously as it expires and I make money on it, then I'm allowed to do, you know, more and more. So what I can do now is wait for Tesla to go up, sell call options on Tesla. I can sell call options on Enphase, and I have the put option on Enphase. So once that expires out of the money, then I have to see if I start selling put options on Tesla or Enphase. And then if the account goes up very much, or I'm doing really, really well, then I would like to introduce a 3rd stock to this that I'm doing this wheeling on. Cool. So let me know, guys, what you think about this. Is there any risk that you will be assigned in the money puts before the expiry date? Very, very low risk, because normally the options have an intrinsic value and an extrinsic value. The intrinsic value is like, let's say your strike price is, let's keep it Rocket Lab because that's very simple. So let's say you sold the put option at 26. So that means that you want the stock to be over 26. That's when you win, right? And if it's below 26, you need to take ownership of the options, so of the stocks. So let's say the stock price is 24. Then you have a $2 intrinsic value because, you know, that's the difference between the strike price and where the stock is at. And then you have extrinsic value, which is time value in the option. So the person who would sell you the share is actually better off just selling his put option, because then he also wins this extrinsic value. But you know, when it comes when the option is very, very deep in the money, like super deep in the money, like let's say you're what I showed you, you know, that I have $760 Tesla option. Mind you, it's a leap, so it's like it has still 1 year on it. But let's say that option would expire you know, today, or, you know, in a week. Then basically this time value is non-existent, so it doesn't make a difference for the person to sell the option or exercise the option. So then you're very likely to get assigned. But if your stock is mildly in the money, or, you know, at the money, you're very not likely to be assigned, even on the last day. Like, I have only got an early assignment, I think once on Enphase, but it's a long story. It even doesn't count. I bought the option very stupidly, and so it was basically like there was a very big bid and ask, and then when I was basically looking at what the broker was saying is the mid price, and somehow, like, I managed to be stupid enough to buy at a discount to the intrinsic value. So let's say that Rocket Lab example, 26 is the put option. The stock is at 24. So the intrinsic value of the option is $2. And I managed to sell the option at like 150, meaning that if you exercise the option directly, then you straight away make 50 cents. And that's exactly what happened to me. And then they obviously just assigned the stocks to me, and yeah, that was very annoying. Cool. That can happen, but generally it doesn't because of the extrinsic value left in the contract, which is Custard and Chips. Thank you so much for helping to answer these people, and you're even a channel member. Are you a new member, or I have not seen you around, or did you recently change your name? Sovereign investor, hello. Adam King, Vince, I told you I wanted to explain things like you were talking to your children. Okay, so very good comment, Adam. Which part is it that you want to explain more? My thing is, this is why I'm doing this, especially live, is I have no idea what you guys know and don't know, and I don't know if I should start from like an option is this. A call option means that you have the right to buy a share at a certain price. A put option is that you can be put a share at a certain price, so somebody can sell to you for a certain price. Like, should I start from the very beginning? Okay, I need investing 101. Okay, I think I'm gonna do it in next week's video. I want to keep it at around 30 minutes unless there is more audience questions, because I love TJ. I watch his content, TJ the Wheel Deal, but I feel that his check-ins, that it's like 1 hour, it's so much that I'm not able to follow it like every episode. And I think that it's very important to see how, with the time, his portfolio and his thoughts and like how it changes. So that's why I'm trying to keep it to 30 minutes. Is that okay with you, Adam? And I made some very important disclaimers at the beginning of this video, and I don't know if you came in the middle, but then I recommend that you go back and watch that about option trading. Maybe option trading is not even right for you. I feel that we're in a bull market, and so many people started to talk about options that people can get like a FOMO of like, I need to get into options. And on this channel, I want to make like a no hype options channel, and it's really not for everyone. And again, if you don't need cash flow, you're going to do better just keeping income high, expenses low, investing every month in the stock market, and picking right stocks, like we did when Rocket Lab was in the 3s and Palantir was in the 6. For one, it's a lot less work. So even if, let's say, with the option trading, I make 50% a year and you make 51% or the same as me, you still, like, doing this option trading is a lot of work. Like, you have to follow your stocks. So you're way better off just investing in stocks. I'm in a situation that I do need the cash flow. My portfolio is together with my dad, who is retiring very soon. And for him to be able to retire, we would have to sell the portfolio, meaning sell Rocket Lab, sell Palantir. And I'm like, oh, we're selling these diamonds so that he can live off of them. And I'm like, is there a way that we can like have the cake and eat it too? And this is how like I came in contact with this selling options. And I think like that's my purpose. So the reason why I'm doing this is I want to help my dad retire and help him find a way that he can have cash flow. Obviously we are what do you call it, like we're splitting the cash flow from the option trading. So if I help him retire, it means I'm also getting a nice income, and we still have our lottery tickets and the fantastic companies that we found, like Palantir and Rocket Lab, and hopefully more companies to come. No, Vince, I generally don't chat, but watch Rocket Lab weekly. TJ and everyone. I do options here in UK. Basically has become my full-time work now. That's awesome. That is awesome. So you're a very good person to have here. Mark Kiwi, with Khosla selling their Rocket Lab shares in bulk lately, I think I'll look at some Leaps. Yeah. I mean, I would definitely buy Leaps when you have a pullback, when you're like, okay, the price is like unbelievably good. I feel that on Rocket Lab, we have not had, like, for example, it's really not a good example because I think that Palantir is extremely overvalued, but it went from like 80 to 60. It was like a clear pullback. And I think that if the stock would have gone to like, the low 50s, like there it's like, okay, this pullback is like too good to be true. And then is a very good time to buy Leaps. I feel that Rocket Lab has gone from like $5 to $30 in almost one go. And now we're just, like having 2 days up, 2 days down, 2 days up, to like, we haven't really had a pullback in a very, very long time. So, and that's also probably why Khosla is selling, because, yeah, I understand why they're doing it. They're very early investors. They're probably have made insane amount of money on Rocket Lab, and some could believe that the price is soon going to get a pullback. Exactly. This is a very, very good comment by James. They, at its root, selling options should be about getting paid to do something you want to do anyway. Exactly. And it's so simple. And I'm telling you, when you do option trading, you're going to learn the hard way. It's not that simple. So yeah. Let me see. I didn't start options earlier because I didn't know what made the options move from day to day. Couldn't correlate them to prices. There are no charts that track the options price through time. There are charts like on Interactive Brokers. I can see the price movement, but the thing is, you don't really need it because the options are derivatives, meaning that their price is derived from an underlying stock. So yeah, if you want to go, we're gonna have more episodes of this, and then we are going to go into different things. One of the biggest things that influences the price of options is the delta, which means for every dollar the stock changes, how much does your option change? So let's say if your delta is 0.5, so that means that for every dollar, again, Rocket Lab is a very good example. So if Rocket Lab goes to $20, from 20 to 21, then if you had a call option that was 50 cents, then it's going to add 50 cents to the value. So it will be, $1, meaning it will be 100% up. There is other things also that influence the options, like theta, which is the time decay. But theta is that's like 80%. And like some, like for example, rho, I believe, is like when the interest rate is changed, and how often does that get changed, right? So the most important are delta, theta, and then some other ones, but I think we will go into it in another episode. What did your dad start with, and how much is he up? I mean, we have the portfolio together, so we started with it's funny because it's being done through a Swedish company, and we converted the money into dollars. And I don't know the exact dollar amount. I know the Swedish krona amount, and it's about $120,000. And it was 3 years ago that we started, and now the portfolio, as you saw, is at 385,000. So it was like a 3x in 3 years. And 1 year we were just doing technical trading. So it's like 2 years since I found Palantir and then Rocket Lab that we are investing in. So like 1 year was a lost year, basically. So basically in 2 years we went from 120 to 380. When is he going to be on Rocket Lab Weekly? So he is a very funny guy. He's Hungarian. He has a very thick accent when he speaks English. And I told him I'm going to have an interview with Peter Beck, and he was like, "Who is Peter Beck?" So I don't know how much value he would give you guys. I'm the one who basically takes care of this account, and of course I check with him the decisions that I do. So for example, like when we invested in Rocket Lab, I did tell him, like, I did do a lot of research on this company, and I'm planning to buy it with this much. And then he's just like, okay, do it, you know. But yeah, he would not add value to Rocket Lab Weekly. But actually, next week on Rocket Lab Weekly, we're going to have a surprise guest, and I'm very excited about that. So it's going to be a very interesting one. So there is someone who's coming to visit me here, and he's going to be live with me on Rocket Lab Weekly. It's going to be very interesting. Yeah, so exactly as you say, each contract has Greeks, and the delta measures exactly. What is kiss in Hungarian? Yes, so kiss in Hungarian is pussy, and yeah, we laugh a lot because, you know, when I'm with the kids, we speak Hungarian, sometimes English, sometimes Swedish, and when we say goodbye in Hungarian, luckily in Sweden, pussy does not mean the same as in English. But it's still funny that when we say goodbye, we can say pussy, pussy. And if there's English speakers, then they always cheer up and laugh. But Swedish is even funnier when it comes to English. Like, for example, speed in Swedish is fart. And the end is slut, but it's like spelled as slut. There's very, very, very funny things in this. But Adam King, how did you know? It seems like you know a little bit of Hungarian. Curtis, you know him. You know my dad? That's awesome. No, I know. I know the guy that you know. And yes. So who is Peter Beck again? Exactly. We don't know. I heard he's a dishwasher engineer from New Zealand, and he's a bit delusional. He thinks he can build rockets that land or something like this. I don't know. And he has curly hair, and he rides donkeys. This is what I know about Peter Beck. Okay, I'm going very off topic. It's at 42 minutes. I think old girlfriend. Yeah. I must say there are some very beautiful Hungarian women. I'm married to one. She's one of the most beautiful women I've ever seen, and there are others. But you know, Swedish women are also very beautiful. So, but I'm sticking with the one that I have. 4 kids. Not looking back. So thank you so much, guys, for being here. If you're watching it on replay, please let me know what you thought about this episode. What can I do better to help you understand options more and take you on this journey with me? And hopefully I will be able to implement these in the next episode. I will try to have it always on Fridays, a day before Rocket Lab Weekly. And maybe one time in the future it's going to be in market hours, so that in case we're trading options together, then, you know, we can check prices and yada yada yada. Anyways, thank you so much for being here. Please make sure you subscribe to the channel, and I'll see you in the next video. Ciao, ciao.